Welcome to the Deep Dive. Today, we're tackling a big one, shortcutting the knowledge from a major holding company's 2019 shareholder letter. We've done the heavy lifting, pulling out the core insights for you.
Exactly. The aim here is to give you a really clear picture of how a truly decentralized, value-focused company actually operates day to day. This letter, honestly, is like a masterclass.
And 2019 was quite the year for them.
Oh, absolutely. Record net earnings, $2.0 billion. And the big one, book value per share, jumped 14.8% adjusted for dividends.
That's a solid year, but the long-term view is, well, staggering.
Oh.
Since 1985, we're talking 19.3% compound annual growth in book value.
19.3%. You just don't get that kind of performance by accident. It comes down to, really, two main things they focus on relentlessly.
Which are?
Disciplined insurance underwriting, number one, and number two, very cautious, value-driven investment management.
Okay, let's start with the engine room then, the insurance operations. How did that look in 2019?
Right, so the main measure here is the consolidated combined ratio. For 2019, it was 97%.
Meaning they made a profit just from selling insurance before investments.
Precisely. Anything under 100% is an underwriting profit. So 97% meant a profit of $395 million just from the core business.
Okay, impressive. And what about growth? Were they writing more business?
Yeah, good growth. Gross premiums written were up 10% overall, hitting $17 billion. But what's really interesting is how that growth happened through the year.
How so?
It really accelerated. Started the year, Q1, around 5% growth. By Q4, it was up at 17%.
Wow. That signals something changing in the market, right? Rates going up?
Exactly, a hardening market. Insurers were finally able to push through needed rate increases.
What was driving that need for higher rates?
Well, a few big things. First, you had the hangover from the huge catastrophe losses in 2017, 2018. That took a lot of capital out of the industry.
But they kicks out.
Second, interest rates were stubbornly low. Insurers hold huge reserves, float, right, and they invest it. Low rates mean less income from that float, so they need to make more from the actual underwriting.
Right, got to make up the difference.
And third, this concept they call social inflation.
Social inflation. Okay, that sounds interesting. What does it mean in insurance terms? Not like Twitter trends.
No, not quite. It's more about the legal environment. Think bigger jury awards, broader interpretations of liability by courts, more lawsuits. It drives up the ultimate cost of claims, especially in areas like commercial auto or liability for company directors.
So costs were rising for insurers across the board, pushing rates up. Was that happening everywhere?
Pretty much most lines saw increases. The main exception was workers' compensation, which remained pretty competitive, so prices were actually falling there for some, like Zenith.
Ah, Zenith.
Yeah.
Let's talk about some of the standout subsidiaries.
Yeah.
Because in a tough market, the really well-run ones shined.
Yeah.
Zenith operates in that competitive workers' comp space you mentioned.
And they were the star performer on underwriting profit, contributed over $100 million with an incredible combined ratio of 85%.
85%. In a line where prices were falling.
Well, just exceptional underwriting discipline and claims management. They know how to pick risks and handle claims better than most. It really shows the power of expertise in a specific niche.
And that highlights the decentralized model, right?
Yeah.
Letting these expert teams run their businesses. Are there other examples of that long-term growth within the group?
Oh, definitely. Look at Crum & Forster's accident and health business. Back in 2000, it was doing maybe $40 million in premiums.
Okay.
By 2019, almost $1 billion. That's 20 years of focus, building expertise, organic growth.
Incredible. That kind of patience is rare.
It is. And you see similar stories elsewhere. Odyssey Group, they turned in a $90 million profit, 97% combined ratio. And inside Odyssey, look at Hudson Specialty.
What about them?
In 2002, they wrote $169 million in premiums. By 2019, $1.7 billion. Again, mostly grown from within, not just bought.
So, strong underwriting, profitable growth. Which brings us to the magic element, float. The letter calls it the gift that keeps giving. Explain that for us. What is float and why is it such a big deal here?
Right. Float is basically money insurers collect upfront for policies, but haven't paid out yet in claims. Think loss reserves, unearned premiums. It's money you hold before you have to pay it out.
So it's like customer cash you get to use for a while.
Exactly. It's essentially capital you hold. In 2019, their float was massive, $22.4 billion.
$22.4 billion. Okay.
But here's the crucial part, the gift. Because they made that underwriting profit we talked about, The cost of holding that $22.4 billion wasn't zero. It was negative.
Negative cost. How does that work?
The underwriting profit itself, that $395 million, more than offset any expenses associated with holding the float. So effectively, they had a 2.0% benefit from it. They were basically paid $395 million to hold and invest nearly $23 billion of other people's money.
That is a powerful advantage. Free capital essentially funding the investment side.
It's the cornerstone of the whole model.
Okay, let's shift focus globally now. They operate all over the world. Where did things go well in 2019 and where did they hit rough patches?
Yeah, it was definitely a mixed bag, which you expect with a global footprint like theirs. On the plus side, Fairfax Asia did well, improved its combined ratio down to 97%.
Okay.
Colonnade, which covers Central and Eastern Europe, had an outstanding year, 92% combined ratio. Really strong performance there.
Nice.
And Fairfax Brazil is a really interesting story. They started it from scratch back in 2009, lost money for the first 6 years cumulatively.
Ouch. Takes patience.
A lot of patience. But in 2019, they finally hit a 97% combined ratio. It shows that long-term view. They're willing to invest, build a market.
But it wasn't all smooth sailing globally.
No, definitely not. Fairfax Latam had a really tough year. Combined ratio of 117%.
Whoa, 117. What happened there?
Two big things, really. One was the super high inflation in Argentina, which messes with reserves and asset values. The other was major unexpected losses from riots and civil unrest in Chile.
Right, external shocks. Any other challenging spots?
Bright, their operation in South Africa, was also just over the line at 101%, mostly due to some significant property losses.
So when you see 117% in LATAM, how does management view that?
Oh.
Is it just cost of doing business in volatile regions, or does it trigger alarm bells about the local management?
I think they definitely see it through that long-term lens. Local shocks happen, Argentina's inflation, Chile's riots. You can't always predict those perfectly. The key is, does local management learn and adapt? The Brazil turnaround suggests they give teams time to figure it out, assuming the underlying strategy is sound.
Okay, that makes sense.
Yeah.
Let's talk about India specifically and Digit Insurance. That sounds like a significant forward-looking bet.
It really is. They own 45% of Digit. It's aiming to be a fully digital insurance company in India, and it got recognition named Asia's General Insurance Company of the Year in 2019.
Impressive. But it's still a startup, right? How are its financials?
Yeah, very much in startup mode. So the combined ratio was high, 124%. That means it's burning cash to grow market share, build the platform.
Which they're okay with.
For now, yes. The letter explicitly noted they expected it to reach break-even within about 18 months. It's a classic example of patient capital for a long-term disruption play.
That commitment to long-term value, even through initial losses, perfectly tees up the investment side of the house.
Yeah.
You mentioned their overall target is a 15% annual return.
Yeah, that's the long-term goal. They think of it as ideally a 95% combined ratio from insurance. So a 5% underwriting profit plus a 7% return from the investment portfolio.
And how do they do on the investment side in 2019? Did they hit that 7%?
Pretty close. They achieved a 6.9% return on the portfolio, which, combined with the underwriting profit, powered that overall 14.8% growth in book value.
Okay, 6.9%. What drove that return? Was it income, capital gains?
A mix of both, actually. They had record interest and dividend income, about $880 million.
Record income, okay.
But the bigger piece was net gains on investments, both realized and unrealized, about $1.6 billion there.
Wow. Where do those gains come from?
A big chunk was mark-to-market gains on some of their equity holdings. They specifically mention the increased valuation of Digit Insurance, that Indian venture we talked about. Also, gains from their stake in Eurobank in Greece.
Ah, Eurobank. That was a contrarian bet back in the day, wasn't it?
Absolutely. Buying into a Greek bank during the sovereign debt crisis? Classic value investing, looking where others are fearful.
So opportunistic equity bets like Digit and Eurobank paying off. But what about the rest of the portfolio? The fixed income side. They're known for being super conservative there.
Extremely conservative. About 70% of the portfolio was in fixed income, and it's very high quality, average rating AA-.
Okay, safe bonds. But the really striking thing is the duration.
Right. Incredibly short, only 1.5 years on average.
1.5 years. That means they're barely taking any interest rate risk, but they're also probably giving up quite a bit of yield, aren't they? Why so cautious?
It's all about protecting the downside, protecting that float capital. By keeping duration super short, they minimize the impact if interest rates were to suddenly rise sharply. They see that stability as the foundation.
The safe foundation funded by the free float allows them to take calculated risks elsewhere, like with Digit or Eurobank.
That's exactly the thinking. Preserve the core capital, use the underwriting profits and the float benefit to make opportunistic, long-term bets on the equity side.
And speaking of caution,
Yeah.
despite that strong 2019 performance, they still held a massive amount of deflation hedges.
Yeah, $100 billion notional value.
$100 billion. In a year, they made $2 billion and grew book value by nearly 15%. Why hold on to such a huge insurance policy against, well, economic collapse?
Because fundamentally they remain skeptical. Even with good results, they looked at the broader market, the valuations, the economic environment, and clearly felt a significant risk of a downturn remained. It wasn't time to declare victory and drop the protection.
Which brings us to maybe the most pointed part of the letter for investors today. The warning about tech stocks. They drew a direct line between the FAANG stocks plus Microsoft and the old Nifty 50.
Yes, this is a core part of their value philosophy, and it's a stark warning. They acknowledge the phenomenal growth of big tech. I mean, the numbers are incredible. Amazon's revenue compounding at 28% a year for a decade, Facebook at 57%.
Unbelievable growth.
Right. But then they immediately pivot to history, the Nifty 50, the glamour stocks of the late 60s, early 70s.
Remind us, what was the Nifty 50 story?
They were seen as one-decision stocks, buy them and hold forever, companies like Xerox, Polaroid, Coca-Cola back then. In 1972, they were trading at an average price-to-earnings ratio of 42 times.
42. Okay, pricey. How did that compare to the overall market?
The S&P 500 index was trading at about 19 times earnings then, so a huge premium for the Nifty 50.
And the letter points out that today's tech valuations are even more extreme.
Much more, yes. They cited Amazon at 79 times earnings, Netflix at 76 times, way higher than the Nifty 50 peak.
And what happened after 1972?
The market crashed in 1973-74. Many of those Nifty 50 stocks fell 70%, 80%, even 90%. And crucially, many took a decade or more just to get back to their 1972 highs, if they ever did. Polaroid, for instance, never recovered.
Oof. So the message is, trees don't grow to the sky.
That's the quote they use. Their bet is that when the current cycle turns, these high-flying growth stocks will get hit hard, and traditional value stocks, the kind they prefer, will offer much better downside protection. They're explicitly anticipating a renaissance of value.
It's a powerful historical analogy, and it explains why they focus on different kinds of assets, like their big investments in India.
Exactly. Look at their stake in Bangalore International Airport, BIA.
Right. What's the story there?
Fastest growing airport in the world, they say. Their valuation on that investment is up 119% from what they paid. And they're doubling down.
How so?
Big expansion plans, $4 billion in capital expenditure, funded either internally or with debt. That's a long-term infrastructure bet, totally different from a high multiple tech stock.
And they have other major Indian holdings too, right? Like Quess.
Yeah, Quess Corp. Started as a smaller investment, now it's India's largest private sector employer in the domestic market. Over 385,000 employees.
Wow.
Again, it's about building sustainable, large-scale businesses over time, often in complex markets. Requires that patience we keep talking about. Same as the Digit insurance venture.
And underlying all this, the insurance discipline, the patient investing is a specific corporate culture they emphasize.
Very much so. They highlight their community commitment, $23 million donated in 2019. Things like working through Thomas Cook India to buy and install 500 dialysis machines in poorer parts of India. Funding a children's hospital. It's part of the ethos.
And they tie that back to employees too with the share ownership plan.
Absolutely. The employee share ownership plan, the ESOP, is crucial for aligning everyone with that long-term value creation goal.
And the returns for employees have been pretty good.
Phenomenal, actually. Since it started, the plan has generated a 14% compound annual return for employees participating. The letter even gives an example. An employee starting on a $40,000 salary, if they participated fully, would have built up shares worth about 2.2 million Canadian dollars by 2019.
That certainly creates partners, not just employees.
It fosters that long-term mindset throughout the organization.
Okay, so wrapping up this deep dive. For you, the listener, the real takeaway seems to be this blend, almost a contradiction, that drives their success.
I think that's right. It's synthesizing two ideas that often seem opposed. On one hand, extremely conservative financial management, the low-cost float, the short-duration bonds, the deflation hedges, minimum risk on the core capital.
But on the other hand,
Highly opportunistic, sometimes contrarian, very long-term value investing. Willingness to buy distressed assets like Greek banks, build businesses from scratch in tough markets like India or Brazil, turn around complex insurance operations.
So conservative foundation, opportunistic growth bets on top.
That's the essence. And the key message from 2019 was, even when things are going well, don't drop your guard. Stick to the philosophy. They saw the market euphoria, especially in tech, and doubled down on their cautious, value-oriented stance. It's not about maximizing returns every single year. It's about minimizing the risk of permanent capital loss over the long run.
Which leaves us with a final provocative thought for you to mull over. The letter uses that Nifty 50 crash as a stark warning for today's high-flying tech stocks. If they're right, and if, as the letter notes, the lead up to that 1970s bubble included low unemployment and rising inflation, what specific economic signs should a careful investor be watching for today that might signal the start of that predicted renaissance of value? Something to think about as you connect these historical echoes to the current economy.